Good morning, madam. My name is Harish. No matric 03 D80 to DF1086. Today I want to present about ethical conflict in the Tyco corporate scandal 2002. First, Denis Koslinski. He is a CEO. Ethical conflict is personal interest versus fiduciary duty to the company. Abuse of authority is misuse corporate funds to personal luxuries such as homes, artwork, lavish parties. Misconduct example is hosted an extravagant birthday party to his wife using company money. Ethical violence is breach principle of integrity, objectivity, and accountability. Commingling of asset is missed personal and corporate funds, violating company policy. Character trait is display greed, dishonest, and lack of professional ethics. Lastly, impact. Damage stakeholder trust, Tyco's reputation, and financial stability. Second, Mark Schwartz, Chief Financial Officer of Tyco International. Main misconduct: assist CEO Denis Kosloki in concerning illegal transaction and falsifying company records. Lack of transparency, manipulated accounting information instead of ensuring accurate financial reporting. Ethical violation is breach principle of professional competence, integrity, and due care. Motivation is prioritize loyalty to his superior and personal gain over honesty and accountability. Professional failure is neglected fiduciary duty and professional responsibility. Impact: contributed directly to Tyco's financial misconduct and loss of stakeholders' trust. Thirdly, Tyco's board of directors, which is governing body. Lack of oversight is board members fail to act and unethical behavior within the company. Compulsity is some remain silent despite knowing about misconduct. Bribery incident is one board member reportedly accepted financial benefit to hide the CEO's unauthorized mention purchase. Conflict of interest. Action represented a clear violation of governance ethics and fiduciary duty. Governance failure is neglected their responsibility to oversee management and protect stakeholder interest. Lack of accountability is shown no social responsibility of professional integrity. Consequence is weak governance, enable ongoing misconduct and damage Tyco's ethical reputation. Prevention is stronger ethical leadership and stricter oversight could have prevented to the scandal.
Hi, my name is Muhammad Abdul bin Abdul Kadir. My nomometric is 03D8023F1998. Now I want to present about ethical conflict in the Tyco corporate scandal 2002. PricewaterhouseCoopers PwC is responsible for auditing Tyco's financial statement. Audit failure is did not perform the audit with dual professional care and skepticism as required by GAAP. Ethical conflict is prioritize maintaining a profitable clients relationship over public trust and audit integrity. Negligent impact is failure to detect Tyco's fraudulent activities leading to major shareholder losses. Accountability is PwC was later held responsible and paid USD to 225 million to settle shareholders' claim. Ethical breach is demonstrate for compliance with professional auditing standard and ethical duties. Lesson is highlight the importance of auditor independence, professional skepticism, and accountability in financial reporting. Next, we have Richard P. Scalzo, the audit engagement partner. The role is engagement partner responsible for Tyco's audit at PwC. Audit negligence is failure to perform duties with adequate diligence and skepticism. Ignored red flag. Did not assess audit risk or investigate sensitive areas like executive compensation and related party transaction. Ethical violation is breaches principle of integrity, professional competence, and due diligence. Ethical conflict is choose career, convenience, and client comfort over professional responsibility and trustfulness. consequence is face legal and disciplinary action for failing to comply with General Accepted Auditing Standard (GAAS). Lesson is demonstrate the critical importance of auditor independence, ethical courage, and professional skepticism in uncovered fraud.
My name is Chukaja. My normal metric is 03DAT23F1123. I want to present about main threat faced by auditor. First is self-interest threat. This threat arises when auditors have a financial or personal interest that could influence their professional judgment. In Tyco case, PwC received substantial audit and consulting fees from the company, making Tyco one of their largest and most profitable clients. Losing Tyco as a client would have negatively impacted PwC's revenues and reputation. Consequently, PwC auditors might have avoided challenging management accounting treatments or requiring further evidence in order to maintain the relationship. Such behavior reflects a conflict between finance gains and ethical responsibilities. Number 2 is familiarity trait. This occurs when a close relationship develops between the auditor and the client over time, resulting in excessive trust. PwC had audited Tyco for several years, creating a friendly and over-familiar relationship with senior management. This familiarity caused auditors to accept management explanation at face value without performing deeper verification or risk assessment. When auditors become too comfortable, they lose their professional skepticism, leading to audit complacency. Number 3 is advocacy trait. This trait occurs when auditors act in the manner that promotes or defends the client interest. PwC may have become overly aligned with Tyco management, attempting to justify or rationalize the company's accounting practices rather than maintaining independence. By failing to report irregularities and protecting Tyco's reputation, PwC gave the impression that it was supporting management rather than safeguarding shareholders and the public. When auditors begin to act as advocates for their client, their professional neutrality is completely lost. Number 4 is intimidation trait. Intimidation trait arises when auditors feel pressure and fearful of negative consequences from the clients. At Tyco, powerful executives like Dennis Kozlowski and Mark Schwartz had immense influence. PwC auditors may have feared losing the engagement, damaging their firm's reputation, or facing personal backlash if they questioned the executive action. Such psychological pressure can discourage auditors from performing their duties objectively and independently.
Now I want to present about safeguard to reduce ethical threat and dilemmas in an organization. There are three main types of safeguard that help maintain integrity, independence, and accountability in professional practice. First, these safeguards are established through professional law and ethical standards. They are designed to promote integrity, independence, and accountability among accountant and auditor. For example, the Malaysian Institute of Accountants (MIA) and International Federation of Accountants (IFAC) provide ethical code that require compliance with GAAS. If firms like PwC had followed this standard carefully, they could have detected the Tyco fraud case much early. In short, this external safeguard act as rule and guidelines set by the profession and law. Next, we have firm-wide safeguard, which are policy applied across the whole audit firm. This aims to build an ethical culture and prevent self-interest or familiarity traits within the firm. An example is implementing mandatory partner relation, independent declaration, and regular ethic training program for employees. Such measures reinforce ethical responsibility and ensure objectivity in audit work. Lastly, we have engagement-specific safeguards, which are procedure tailored for each individual audit engagement. These safeguards help maintain independence and encourage professional skepticism during the audit process. For example, firm can assign separate team for high-risk areas like executive compensation or related party transaction. They can also include independent review partner to double-check key audit decision. This ensure that fully and without bias.
Assalamualaikum warahmatullahi wabarakatuh and good morning. My name is Muhammad Izzuddin bin Subri, number metric 03D8023F1114. Today I will present about the three weaknesses in corporate governance in the Tyco corporate scandal. Firstly, lack of oversight by the board of directors. The board of directors failed to perform its monitoring role effectively. They did not question or review Denis Kozlowski's personal use of company's fund, allowing him to misuse corporate assets. This shows weak supervision and lack of accountability within the company's top management. Number two is absence of internal control and audit system. Tyco had a poor internal control system to detect fraud or unauthorized transaction. There was no proper review or segregation of duties, which enabled Kozlowski and Swartz to manipulate financial record and conceal illegal payment for years. Then lastly, and number three, ineffective ethical culture and whistleblowing mechanism. The company lacked unethical corporate culture. Employees were afraid or unwilling to report unethical activity because there were no safe whistleblowing channel or ethical guidelines. This allowed an ethical behavior to continue without challenge. That's all for me. Thank you.